TR Property Investment Trust invests in primarily pan-European real estate equities, listed companies, but it also has up to 15% of its assets in commercial property in the UK. So our investment process is governed by our desire to beat the benchmark, and therefore everything is run relative to that benchmark. We use a top-down and bottom-up strategy. Top-down, we're looking for sectors across Europe, subsectors, be it Paris offices or industrial in southern Germany, etc., healthcare, self-storage, student accommodation, markets that we think are in a growth phase. And then bottom up, we're looking for the best companies that we believe will be able to capture that growth through a reflection of their quality of their balance sheet, their ability to asset manage, development profiling, etc. Being a pan-European vehicle, we invest in obviously a number of currencies, and we run the currencies in line with the benchmark exposure. So even though we may have a very high conviction towards Switzerland, for example, we will only hold a currency weighting in line with that of the benchmark, which in the case of the Swiss franc today is about 7%. So we'll run forwards, buying or selling forwards to manage that currency. But as an investor, you should be aware that your exposure is about 1/3 sterling, 50% euro, and the other smaller European currencies as well. Risk is really around, because real estate is a leveraged asset class, so your real risk as well is around a rapid change in the cost of money. So that's both a risk and an opportunity. So ESG is clearly three components to that. From the governance point of view, we are a big fish in a small pond, and we have a lot of exposure to small companies. So we have a huge amount of engagement with boards of our small and mid-cap stocks where we have large holdings in those companies. From a social perspective, property is ultimately a part of our infrastructure. We all need to live, work, and play in it. The environmental is a much harder set of metrics to get our heads around. What we are able to do is entirely control the bit that we own, so the physical property, commercial property in the UK, and there we're doing absolutely everything we possibly can, including all our new leases are green, solar panels on all our roofs, and everything that making sure that all our real estate moves to an EPC grade A or B in the next 5 years. The trust does use gearing. We have a maximum gearing of 20%, and historically we have also moved to a 20% cash position. As far as a discount control mechanism is concerned, we don't have a formal discount control mechanism. The board feels strongly that as a single sector asset class, when we are out of favour and our own stock is trading at a big discount, the chances are that the companies that we can buy are trading at even larger discounts. So there's an opportunity to invest in those businesses very cheaply. Having said that, I've been involved in the trust now for 25 years, a hell of a long time, and we have bought back over that time around 1/3 of the equity. So as an investment in real estate equities, we see very much it's real estate, so you can either view it as the sort of growth end of the bond trade because it's essentially income with a capital kicker, or you describe it as the value end of the equity trade. You know, it's not your go-go internet stock. It's steady. It has a relatively high income, and I would see it sitting very much in that as a core holding in your portfolio, generating that hopefully inflation busting income return.